What's going on, everybody? Michael here. The big backtest is taking place in the dollar. This is an important level to watch. As you can see, it's acted as prior resistance, and will resistance potentially turn into a level of support? If it does, we may see more red on the screen like this. What a crazy, crazy day. Somebody very well enjoyed it. Overall, though, the dollar, which we are talking about, is still within this wedging type pattern. And if it starts breaking out to the upside, we know that the S&P 500 and various other assets can be affected by that when we look at like its correlation with the S&P 500. So if you look at different time frames 15, 30, 90, 120, and 180, you can see that they all have negative correlations. However, with this recent chop in the S&P 500, the correlation, there isn't really a strong correlation as it stands on the very shorter time frame. We got a lot to talk about on today's stock market brief. My name is Michael Silva. Once again, if you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated. Pardon me if I'm a little shortness of breath here and got a crazy foggy head. I coming out of the whole COVID thing, so it's been pretty rough. But we're going to go ahead and get into it. All right, we're going to go ahead and start off with this specific chart, the NAAIM, which is the National Association of Active Investment Managers. And all this does is it just represents the average exposure to the equity markets by the members within this. And it's just really a good sentiment indicator. Sometimes when it gets really overly bearish, it could be a time to become bullish in the markets. And when it becomes, like, for example, right here, the bottom of the COVID, right? Boom, time to get bullish, right? When it got really bearish right here, very bearish that we haven't seen in 2022, boom, it marked a short-term bottom there. But the opposite is true when it gets overly bullish. Sometimes that could be a contrarian indicator too. And I'm just calling out that, we're reaching a level that we've seen a few times here in 2022. I've highlighted them here. And you can see that every time that we reach up to these levels, the market, the contrarian kind of play took place. So are we about to see a continuation of this similar pattern where we get some more further downside? I don't know. I just thought it was an interesting data point that I wanted to share with you. Tomorrow we have some data coming out. Nothing too crazy, no major reports, at least reported by Trading Economics Calendar. But at 6:45, we have S&P Global Manufacturing PMI Flash, Global Services PMI Flash, and then Global Composite PMI Flash. But the big thing too also is we have a huge option expiration, which could make it very difficult in volatile trading environment. If we take a look at the bigger picture, we're looking at a quarterly chart. This is something that I've shared quite a few times. I'm not going to get too much into why on this specific episode, but in short, I always like to look at that 5 quarterly EMA, because if we start getting closes beneath it on a quarterly basis, the Fed typically steps in. But when we get 2 in a row, they didn't typically step in, and the last times that happened was here at the dot-com bust, and that also happened here at the Great Financial Crisis. And as you can see, it happened again here, and we're currently trading right around that quarterly 5 EMA as it stands, which is it's at 39.38, where price closed at 38.95 today. Now, if we take a look at the monthly expected move, it's going to be the solid line on the S&P 500. The solid line, you can see price is where it came right into it today, and it held right into that area. That doesn't mean that it can't break down from those levels, but it is something to note that we are at the bottom range of the monthly expected move. We are still above bear market territory if you measure bear market territory as 20% from the high down. That would represent, we're not too far off of it. We came very close to entering back into bear market territory today. This is a monthly time frame. All right, and we're back below the 5 monthly EMA there too as well. So the dash lines, for those that are interested, are the quarterly expected moves. So it's going to be, we have the remainder of this month to finish the quarter. So we're within the quarterly expected move here. We came outside of it. And then we touched the top of it, and then we started breaking back down into it as it stands right now. So we will see what continues on. I want to look at the weekly time frame and give you another interesting view, and that is looking at the weekly 50 period moving average. And you can see here we had a very precise tag of it on this bear market rally. And then right here this week, we had a very precise tag and it started to reject from that area. So are we going to see, another retest of potentially this 200 weekly moving average? You can see they are starting to contract, come closer together. But really overall, we haven't really moved anywhere for, since March of, earlier this year. You can see we're right there, just going chopping back and forth. Now, if you take a look at the NASDAQ 100 on the weekly time frame, this one I posted on Twitter. This has a pretty well-defined bear flag structure, and we're right below the 200 weekly moving average. It is still inclining, but I wanted to just call out that, hey, if this does want to make a full breakdown measure move of, say, this bear flag right here, that would take us to roughly 9,000, which is just below the pre-COVID high. So is that possible? I think it's a possibility for sure. I'm not going to rule that kind of stuff out, especially with what the Fed is doing. The Fed came out, they raised their 50 basis points. We all know, I'm not going to dive too much into that, but I will say that, people were getting very hopeful for a pivot and for a cut. And even somebody asked that question today or on the Fed meeting, and he shut that down almost immediately, and when the market's responding pretty poorly. So we'll continue to monitor and see what develops. Overall, though, if you take a look on the daily time frame, we've been getting this broadening type pattern taking place in the S&P 500, which could tend to mark reversals, which we've seen in the past. Sometimes diamond patterns can cause reversals. Sometimes, all kinds of different patterns can cause reversals. But we have been seeing, wild swings back and forth of expanding volatility. And now we finally cracked down through these previous swing lows over here, and we're starting to see some increased volume. So this could be the start of a potential further move to the downside to tag that lower weekly expected move, or even break down from, we talked about this rising wedge structure, how it broke down, back tested, and now we're starting to see some more continued weakness. So we'll see if we get some continuation, but this has been a very strong 3-day move to the downside with some supportive volume, and it's really erased all of this data back here, which we saw, all kinds of, reports and Fed talk, right here. It's just been a wild trading week. If you just take a look to the left, this level, this 3,900 has been a very, it's almost like a magnet point in the markets. You can see it's acted as support, resistance, support, resistance, support. And now it's starting to break back down. It hasn't had, a couple of days of close, but the longer it stays down there, the more likely it could potentially turn into another period of resistance, which could, present itself as more further downside in the S&P 500. If you take a look here on the 15-minute time frame, tomorrow we're expecting around a $5 plus or minus move. This is what the options market is pricing in. I drew it out here in this gray box. We're below a 5-day moving average. It's declining. It's rather neutral, to be honest. But you can see here the price action, it just hasn't been going anywhere. And we finally got some, a pretty sizable crack in the structure of this chop box. So we'll see here if this is just something that we saw here where we break out and then it came back in. We broke out and it came back in. Perhaps this is breaking out and we're going to come right back in. Overall, when you look at this, though, from the weekly perspective, understand that we're only down, with all this volatility, we're only down about 1% in the S&P 500. The weekly candle does not look too good, so it's going to be interesting to see how this finishes come tomorrow. But we did have a strong move up, and now we're creating a shooting star, type candle or an inverted hammer candle, which can mark potential reversals in the market. So we'll continue, obviously, to watch that. We've been talking about the summation index, and we called it as soon as it triggered over, right over here. We said we continue to watch to see when it converts over because it could identify a potential change in trend. And as you can see, we did. The parabolic star is over, and the market's starting to kind of roll itself over here. So are we going to get continued movement to the downside? Is the parabolic star going to start going like that, and we're going to see more? Well, as it stands right now, that is what it's indicating, but it doesn't mean that we can't just turn right back up and start whipsawing back around. So that's always a possibility, but as it stands right now, we are below zero on the summation index for the NASDAQ. And it's not looking all too hot right now. Okay, the summation index for the New York Stock Exchange is above zero, so that's a little bit more positive. We were watching for that NIMOT to cross below zero, and we are getting that weakness. Overall, though, it hasn't really broke this could be a very well a head and shoulders type pattern, which if it breaks down, it could take us to around that 14,500 level on a full measured move. But it is starting to point down. The parabolic SAR ticked over. We have been watching that negative divergence. We've been warning about that. And now we're finally starting to see this weakness come to fruition. But always be careful, because bear markets, you see face ripping rallies. And I can't say that enough. I'll look at the zones really quick with you. The zones here, were bright red not too long ago, and then they became more neutral, and now the within the range of the zones, they're all bright green again. Why? Because everything got completely smashed to the downside today. So now it's coming to the lower ends of these zones. It does not mean that they can't stay down there, but just understand that, hey, you don't necessarily short in the hole. So as we close today on a gap down and a further move to the downside, there could be some continuation, but just be aware that if you start shorting because of FOMO, it's the same thing that can happen if you start going long because of FOMO. Let me remind you once again that if you saw this gap up and all of a sudden you're whoever on, wherever, and you're saying like, yep, we're going to the moon now, and then all of a sudden it got completely reversed on you, and then boom, oh no, it's okay, boom, and then back to the downside. So this is not, it's similar like this, right? The bears are celebrating, okay, cool, but don't get overly confident, because we can come right back up to this volume shelf profile 396 in the matter of a moment's notice, okay? So once again, products, the SPY, various equities, whatever assets, they move between expansion and contraction. Okay, to have better risk to reward, you want to be able to find stocks that are contracting, and then you can play them like so, right? So you have an expansion move, things contract. Oh, you play the breakout, you have a tight stop loss, and you play it up. Oh, awesome. Okay, cool. Same thing here. Boom, to the downside, right? You had a bear flag structure right here. So if you played the breakdown, you had a stop loss, boom, you can play it all the way down, right? These plays have been working out, and I know it's easy to look at it in hindsight. So what do I see now? Well, as I stand right now, we are below a 5-day moving average. So it's bearish area, stance as it stands, and we have this volume shelf profile here. So if we start bouncing up into this area, the 5-day moving average starts coming back down, this could very well look like something like a bear flag, and then that could potentially play into a lower area or this gap fill, right? This weekly expected move is 380. That is going to change come to the close of business tomorrow. That's all I got for you on today's episode, everybody. Thanks for bearing with me with this whole COVID thing, man. I can't wait to get it out of my system. My brain is just like, it's just been rough. All right, everybody. See you later.